You know, when you look at a map, right, or like a set of architectural blueprints, we all kind of operate on this shared consensus that what we're seeing represents physical reality.
Yeah, you assume it's true.
Right, like if the map shows a bridge, you trust the bridge is there. But when you step into the world of financial markets and you open up a price chart, that shared consensus might actually be the exact thing working against you.
Oh, absolutely. It's a completely different landscape.
It really is. So welcome to this deep dive. Today, we are taking a pretty massive stack of trading guides and financial analyses. We're looking at sources like Trade for Good, Daily Price Action, Think Capital, Strike, and Zireman Trading.
A really solid mix of perspectives in there.
Totally. And our mission today is to decode the hidden language of financial markets, which is known as smart money concepts. And I just need to tell you right now, whether you are actively managing your own trades every single morning, or you just simply follow market trends and want to know how global wealth actually moves, you might be looking at your charts completely backward.
Yeah, because the paradigm shift we were talking about here, it fundamentally changes how you interpret a chart.
We're basically going to explore how large institutions and algorithms actually deliver price, right?
Exactly. I mean, traditional retail traders and institutional smart money, they look at the exact same candlestick patterns, the exact same peaks and valleys, but they are playing two completely different games on that same board.
Okay, let's unpack this, because if you are charting right now, or if you follow any kind of standard technical analysis, the most fundamental concept is support and resistance.
Right. The idea of a floor and a ceiling.
Exactly. A stock drops to a certain level, bounces, drops to that level again, and bounces. And retail traders call those equal lows or equal highs. We are essentially taught to see those levels as safe structural walls.
Right. The prevailing retail logic views those equal highs or equal lows as protective barriers.
Like a shield.
Yeah, the thinking is usually, price failed to break this level 3 times, so it's a highly secure place to put a stop-loss order right behind it. Or, conversely, traders place breakout buy orders just above that ceiling, anticipating a massive surge if the level finally breaks.
Makes logical sense on the surface.
It does, but institutions, I mean the banks, hedge funds, the algorithms executing billions of dollars in volume, they do not view those areas as structural support or resistance. They view them as liquidity pools.
So wait, where a retail trader sees a solid brick wall to hide behind, the institutions see a piñata full of stop losses just waiting to be smashed open.
What's fascinating here is that the institutions actually require that piñata just to function.
What do you mean by require?
Well, we have to consider the sheer scale of the orders these major players are executing. If a large institution needs to buy, say, hundreds of millions of dollars of a specific currency or asset, they can't simply click buy the way an individual trader does.
Right, they can't just log into an app.
Exactly. The market simply doesn't have enough organic resting liquidity at any given second to absorb that massive order. If an institution bought all at once, their own immense demand would cause the price to instantly skyrocket.
Because there aren't enough sellers.
Right. And they would experience severe slippage, getting just a terrible average entry price on their own position. So to buy that much volume efficiently, they need an equal opposing amount of sell orders to match with.
Which means they need people to sell to them at the exact moment they want to buy it and at the exact price they want to buy it.
Exactly. And the most concentrated cluster of guaranteed sell orders is resting directly below that quote-unquote safe brick wall of support.
Ah, the retail stop-loss orders.
Yep. When a retail trader buys an asset, their stop-loss is technically in order to sell. So institutional algorithms intentionally drive the price down just past those equal lows to break the perceived wall.
And grab all those orders.
Yes. This mechanism is called a liquidity sweep or a stop hunt. The dip triggers that cluster of retail stop losses, generating a sudden flood of sell orders. The institutions step in, absorb all of that selling pressure to quietly fill their large buy orders, and having collected the necessary liquidity, they reverse the price in their intended direction.
Man, that structural reality perfectly explains that classic, super frustrating experience so many traders report. I mean, you analyze a trend, you pick a direction, you set your stop loss safely behind a support line.
And then the market dips down.
Yes. It takes you out of your trade by a single tick and then immediately reverses and runs in the direction you predicted all along. It feels deeply, deeply personal.
Oh, I know. But it is entirely impersonal. The algorithm is specifically hunting that cluster of orders because it's a mechanical necessity for large-scale execution. The liquidity literally must be swept to fill the institutional positions before the market can reverse.
So once the institutions smash the piñata and sweep that liquidity, what happens next? Because if they are injecting hundreds of millions of dollars into the market in a very short window, surely that leaves some kind of trackable footprint on the chart.
It does. It leaves a highly specific algorithmic footprint called a fair value gap, or an FVG.
FVG, got it.
Yeah. When those large orders are executed following a liquidity sweep, a price moves away from that zone with just violent, unbalanced speed.
I have seen this term extensively in our sources.
Yeah.
But what are the actual mechanical requirements for a fair value gap? Like, what does it look like on my screen?
It is a strict 3-candle sequence.
Okay, 3 candles.
Right. Picture 3 consecutive candlesticks on your chart. Candle 1 establishes a starting point with its high or low wick. Candle 2 is the displacement candle. It has an unusually large body representing a rapid, aggressive surge in price.
So a big, solid bar.
Exactly. Then comes Candle 3. For a true fair value gap to be validated, when Candle 3 closes, its wick must not overlap with the wick of Candle 1.
Let me visualize the mechanics here. So you have a literal empty vertical space on the chart running alongside the body of Candle 2, where the price moves so fast that the wicks from the neighboring candles, Candle 1 and Candle 3, they literally never touch each other.
That physical empty space left behind on the second candle is the fair value gap.
That's wild.
It represents a temporary pricing inefficiency. It's an imbalance where the price moved so aggressively due to one-sided institutional volume that orders were not matched fairly between buyers and sellers. The market essentially skipped over that specific price tier.
Wait, isn't a gap just normal market volatility? Like, if a stock jumps overnight after a massive earnings report, it leaves a huge gap on the daily chart. Is that the same mechanism?
We need to make a crucial distinction there. Traditional overnight gaps, like the ones you see at the Monday morning equity open, those are caused by the market being physically closed while external news happens.
Right, the price adjusts while nobody can trade.
Exactly. But the fair value gaps tracked in smart money concepts are intra-session gaps. They occur while the market is open, actively trading, and highly liquid.
Oh, wow. So they are not happening because the exchange was closed and suddenly reopened. They are happening because an entity with incredibly deep pockets just aggressively hit the live market with massive volume.
Yes. And our sources provide really compelling historical evidence of this mechanism. Look at January 5th, 2026.
What happened then?
On that specific day, BlackRock accumulated roughly $372.5 million in spot Bitcoin ETFs.
Wow, that's huge.
And because they were buying spot ETFs, which involved purchasing the actual underlying asset, that immense institutional influx heavily impacted live liquidity.
Makes sense.
If you pull up the hourly Bitcoin chart for that day, that specific volume created a distinct textbook fair value gap. A huge displacement candle blasted upward, leaving a clear, unfilled space between the wicks of the candles before and after it. It was a visible footprint of smart money entering the market lies.
And the sources note that major fundamental news events act as catalysts for these intersession gaps as well, right? Like on August 1st, 2025, there was a non-farm payrolls report that printed a significant fair value gap on the URD forex chart.
Exactly. In those instances, the economic data release acts as the trigger. The algorithms and large institutional players react to the new data so aggressively, trying to reposition their portfolios all at once, that they create the exact same structural imbalance and leave the same 3-candle footprint.
Okay, so identifying a gap is one thing. It is satisfying to point out a chart and say, look, a major institution stepped in right there. But why does the price almost always return to fill that gap later? Why doesn't the trend just continue indefinitely?
Because the market operates as a highly efficient, continuous algorithmic engine, and its primary directive is to balance the books.
Balance the books, okay.
This brings us to the cyclical relationship between internal range liquidity, or IRL, and external range liquidity, or ERL.
Let's break down those terms. What separates the internal from the external?
Well, external range liquidity consists of the major swing highs and major swing lows on your chart. These are the outer boundaries of the current price action, and crucially, they are where the retail stop losses, the liquidity pools, are resting.
Okay, and the internal?
Internal range liquidity consists of the pricing inefficiencies left inside that range, namely the fair value gaps.
It sounds kind of like a rubber band stretched between two pegs. The market algorithm snaps outward to grab the external liquidity, the ERL, sweeping those stop losses. But doing so requires so much force and speed that it creates a fair value gap on the inside.
Exactly.
So the tension violently pulls the market back inward to the IRL to restabilize, basically rebalancing that gap before it gathers enough energy to be launched toward the opposite external peg.
That is a perfect analogy. And if we connect this to the bigger picture, understanding this specific algorithmic ping pong effect provides what smart money traders call their daily bias.
Daily bias,
Yeah.
knowing which way it's going to go.
Right. If you observe the market sweep external liquidity and you see a fair value gap form as the price moves away, you have a mathematical probability of where the algorithm will draw the price next. It is literally programmed to return to the IRL to rebalance that inefficiency before it can make a legitimate, sustained push toward the next external target.
The sources mention a very specific threshold, too, regarding how far the price has to dip back into that gap to satisfy the algorithm. It's referred to as the 50% rule, or consequent encroachment.
Consequent encroachment is a fascinating mechanical detail. The market does not always need to fill the entire gap perfectly to the penny to restore balance.
Oh, really?
No, algorithms frequently view the exact 50% midpoint of a large fair value gap as the equilibrium of fair value. Once the price retraces and tags that exact 50% level, the imbalance is mathematically considered mitigated by the algorithm, and the price will violently reverse again to continue its primary trend.
Okay, here is where I have to push back a little bit. This sounds incredibly precise in theory, but if I open a 5-minute chart right now and just zoom in, the market looks chaotic. I'm going to see 3 candle gaps everywhere.
You definitely will.
Right. Every little spurt of momentum leaves a gap. How do you distinguish actual institutional footprints from just random, meaningless market noise?
That is honestly the most common trap for anyone applying these concepts. You cannot trade every gap that forms.
I'd go broke.
Exactly. You have to filter the noise by observing the context around the gap. The sources detail 4 strict contextual rules for identifying high-probability setups.
So context is everything. Where do we start filtering?
First is trend alignment and structural breaks. The fair value gap cannot occur in a vacuum. It must either align with the established broader trend, or it must be the direct cause of a confirmed change of character.
Which traders refer to as a CAUUSD, right? What exactly constitutes a change of character on a chart?
A checky happens when the prevailing trend makes a sudden, definitive structural pivot. If the market has been making lower lows and lower highs, a Shaykar CH occurs when a sudden burst of momentum breaks through the most recent structural high, signaling the trend is shifting.
Got it.
And the displacement candle that creates your fair value gap needs to be the force that physically breaks that structural level. It has to achieve some kind of technical damage to the old trend to prove there is real, sustained institutional intent behind it.
That makes perfect sense. It needs to prove its strength. But what about where the gap is located? Does the algorithm care what price it enters at?
Very much so. This brings us to valuation, which relies on Fibonacci retracement levels. Institutions utilize algorithmic pricing models to ensure they aren't buying tops or selling bottoms.
Yes.
Right. If you measure a price move from its origin to its peak, algorithms are programmed to seek entries in specific valuation zones. You only look for fair value gaps that fall into the discount zone, meaning they sit in the bottom 50% of the move. More specifically, the algorithms often target the 0.618 to 0.786 Fibonacci pocket, which is considered optimal trade entry. You want to buy low in a deep discount. Conversely, you only sell into gaps that have formed high up in a premium zone.
Buying at a deep discount and selling at a premium.
Okay, so we have the structural break and we have the Fibonacci valuation. Yeah. Is there a fourth rule?
Yes. The gap must be unmitigated. It has to be fresh.
Meaning untouched.
Exactly. If the price has already retraced, touched the gap, and bounced away previously, the algorithmic balancing has already occurred. The internal liquidity has been filled. A fair value gap is generally a one-time use mechanism.
Here's where it gets really interesting and potentially a bit concerning to me. If we need a liquidity sweep to start the move, a change of character to confirm the structural shift, an FVG that caused the break, and we have to wait for the price to drop into the exact 0.618 Fibonacci discount zone before we enter.
A lot of criteria. It is. Couldn't stacking all of this quote-unquote confluence lead to intense analysis paralysis? Or worse, could it make us just hallucinate and force a setup that isn't really there just because we desperately want to execute a trade?
You are highlighting a profound psychological danger here. The Zierman trading source dedicates significant attention to this exact risk. Overstacking confluences is a major pitfall in technical analysis.
It's just too much data to process.
Yes. Traders will look at historical backtests, layering on rules and optimizations until their strategy appears to have a near 100% win rate on paper. But live markets are messy, unpredictable environments.
Absolutely.
Over-optimizing creates a false sense of absolute certainty. A trader starts believing their specific setup cannot possibly fail because 5 different contextual clues line up perfectly.
And the moment you believe a trade cannot fail, you drop your guard and risk way too much capital on a single position.
The reality is that even a flawless setup, a clear liquidity sweep, a beautiful structural break, and perfect Fibonacci alignment, it will still fail sometimes simply because broader macroeconomic conditions or unseen order flow shifted unexpectedly.
It's all probabilities.
Exactly. The patterns provide a mathematical edge over a large sample size of trades. They do not provide a crystal ball for the next 5 minutes. This is why the sources universally emphasize that mastering smart money concepts does not replace strict risk management. Limiting exposure to 1 or 2% of your account per trade remains mandatory.
So if staring at charts all day, hunting for these complex spatial setups inevitably leads to forced trades and psychological fatigue, how do we constrain ourselves? The sources suggest the solution doesn't lie just in analyzing what the price is doing, but analyzing when it is doing it.
Yes, moving from spatial analysis to temporal analysis is often the key to consistency. This brings us to the ICT silver bullet strategy.
The silver bullet.
It is a time-based algorithmic trading model designed specifically to remove the psychological burden of constantly monitoring charts. Instead of looking for setups all day, it focuses purely on highly specific 60-minute macro windows.
Just 1 hour at a time.
The strategy focuses on 3 specific 1-hour windows per day. First, the London Open,
Which is when?
from 3.0000 a.m. Eastern Standard Time.
Okay, and the next?
The New York AM session from 10:0000 a.m. EST, and finally, the New York PM session from 2.000 p.m. to 3.000 p.m. EST.
So what does this all mean for the execution? Are you saying the time of day acts as its own foundational indicator? Why are algorithms supposedly more predictable during these specific 60-minute blocks?
This raises an important question. We have to remember the human element driving these algorithms. Institutions are staffed by humans running scheduled programs, and those programs are designed to execute massive institutional volume during times of peak market liquidity to avoid the slippage we discussed earlier.
I think that makes sense.
Consider the 10.00 a.m. to 11.00 a.m. New York window. The U.S. equity markets open at 9.3 a.m. EST. That opening bell creates a flurry of chaotic retail-driven volume as overnight orders are processed and reactionary trades are placed.
The piñatas are being stuffed with fresh retail liquidity during that first 30 minutes of trading.
Exactly. By 10:00 a.m., that initial chaos has settled. The liquidity pools have been clearly established by the retail participants, and the institutional algorithms step in. They sweep that freshly deposited liquidity and establish the true, sustained directional move for the rest of the daily session.
That is brilliant.
Without the element of time, a fair value gap on a 1-minute chart is just empty space. But if you see a liquidity sweep followed by a fair value gap strictly between 10:00 a.m., the probability that the gap is backed by genuine, heavy institutional volume is significantly higher.
So a trader utilizing the silver bullet strategy essentially sits on their hands and ignores the charts completely until the clock strikes 10:00 a.m.
Pretty much.
Then they drop down to a very fast time frame, like a 1-minute or 3-minute chart, and hunt for that exact sequence. A quick sweep of retail stop losses, a violent displacement leaving an FVG, and an entry on the pullback into that gap. And they are targeting, what, a very specific surgical profit.
The sources indicate the target is usually a highly consistent 20 to 30 pips.
Pips?
Yes, a pip stands for percentage in point, which is the smallest standard unit of price movement in forex trading. The goal is not to catch the entire daily trend. The goal is to extract a precise, predetermined slice of profit during a window of guaranteed algorithmic volatility. Once the hour's up or the profit is hit, the trader walks away.
That level of constraint is fascinating. By strictly limiting the time you are allowed to look at the market, you naturally filter out the vast majority of false signals, consolidation periods, and just random market noise. You align your execution with the exact moments the algorithms are mathematically required to be active.
It really is a game changer for discipline.
Well, this has been a deeply illuminating look at how markets function beneath the surface. For you listening, we've essentially taken the traditional view of technical analysis and flipped it completely on its head today. We explored how the walls of support and resistance you've likely relied on are actually liquidity traps pools of stop losses specifically targeted by institutional algorithms. We've seen how sudden bursts of institutional volume leave behind trackable footprints called fair value gaps, and how the market operates as a continuous engine swinging between external and internal liquidity to balance its books. And finally, we looked at how time-based strategies like the silver bullet allow you to filter out the noise and track those footprints by trading only when institutional algorithms are forced to show their hand. You now possess a much clearer lens to view the mechanics of price delivery. But I want to leave you with a final thought to mull over on your own.
Let's hear it.
Everything we discussed today relies on one foundational premise. Retail traders are predictable. The algorithms hunt their stop losses because those orders are consistently placed right below obvious structural lines. But with concepts like fair value gaps and liquidity sweeps becoming increasingly mainstream, taught openly on platforms like YouTube and in deep dives like this one, what happens as the broader retail public adapts? If the masses stop putting their liquidity in the obvious places and everyone starts waiting patiently for the 50% retracement into a fair value gap, will the institutions be forced to evolve their programming? Will the algorithms of tomorrow be redesigned to hunt the newly educated, smart money retail traders themselves? It makes you wonder. If you look closely enough at the map and realize the bridge is actually a trap, you have to ask yourself who's drawing the map for tomorrow.